It happens every single year, right around springtime. The weather starts getting nicer, you see the sun a little more, you're feeling a little optimistic, and then it arrives. That email. Or maybe it's a physical envelope that just feels heavier than the rest of the mail. It's your W-2, or your 1099. And suddenly, that optimism just evaporates. You start doing the mental math, or you log into whatever tax software you use and you go through the motions. You punch in your salary, which, honestly, felt pretty decent throughout the year. You feel like you worked incredibly hard for that number. You sacrificed weekends, you stressed over deadlines, you dealt with that one manager who doesn't understand personal boundaries. You earned it. But then the software runs the numbers. It shows you your total income, and right next to it, the total tax you paid. Federal, state, FICA, Medicare, and you just stare at it. There's this very specific, sinking feeling in your gut where you think, wait a minute, I paid how much? Where did it all go? I feel like I'm running on a treadmill set to maximum incline, and I'm barely staying in place, while the government is just standing there holding a giant bucket under the sweat output. It feels unfair. It feels like the system is rigged against anyone trying to get ahead by just working hard. And the thing is, that feeling isn't wrong. It's actually mathematically correct. My name is Marcus Sterling, and I spend way too much time, probably an unhealthy amount of time, honestly thinking about money, financial psychology, and why some people seem to effortlessly build massive wealth, while others stay stuck in the same financial patterns for decades, stressed about their bank account balance every month. I'm obsessed with the why behind the numbers. And one of the biggest whys out there is the tax gap. We all see the headlines, right? You know the ones. Billionaire pays less of a percentage in taxes than their secretary. Or tech giant pays $0 in federal income tax. It makes your blood boil a little bit. But once the anger settles down, if you're anything like me, the curiosity kicks in. How? How are they doing it? Is it illegal? Is it just a bunch of offshore accounts and shady briefcases full of cash like in the movies? Spoiler alert, it's usually not illegal. It's actually terrifyingly legal. And it's not about hiding money in the Cayman Islands, though I'm sure some of that happens too. The real secret, the mainstream strategy used by the ultra-wealthy to basically opt out of the tax system that cripples the rest of us, comes down to a three-word philosophy. It's a framework that completely flips the script on how we're taught to think about money, debt, and income. It's called buy, borrow, die. Sounds kind of morbid, I know, but stay with me, because understanding this is absolutely crucial if you want to understand how wealth actually works in the modern world. To understand why buy, borrow, die works so well, we first have to understand why the normal path, the one most of us are on, is basically a tax trap. Think about your financial life. What were you taught? Go to school, get good grades, get a good job with a steady paycheck. Work hard, get a raise, get a promotion. The entire system is built around maximizing your income. And here is the fundamental problem. In most parts of the world, and certainly in the US, income is the most heavily taxed thing you can possibly have. We have a progressive tax system, which sounds nice in theory, right? Those who earn more, pay more. It seems fair. But in practice, for the high-income earner, the doctor, the lawyer, the specialized engineer, it's like climbing a ladder where the rungs get further apart and more slippery the higher you go. You get that big promotion, you're making 200, 300 grand a year now. That's amazing. But suddenly, every extra dollar you earn is being taxed at 32% or 35% or 37%, plus state taxes. You are working harder, taking on more responsibility, but you're keeping less and less of every new dollar you generate. You are on the hamster wheel, earning money, paying tax on it immediately before it even hits your bank account, spending what's left to live, and then maybe saving a tiny sliver at the end. The wealthy, and when I say wealthy here, I mean the ultra-high net worth individuals, the centimillionaires and billionaires, they do not play this game. They have completely opted out of the W-2 income rat race. They understand something fundamental: income is for spending. Assets are for wealth. If you look at the tax returns of some of the richest people on the planet, and we've seen some of these leaked over the years, like the ProPublica leak, you'll notice something weird. Their actual, taxable income is often surprisingly low. Jeff Bezos, for a long time, took an annual salary of just over $81,000 as CEO of Amazon. 81 grand. There are middle managers at regional paper companies making more salary than the guy running Amazon. Mark Zuckerberg took a $1 salary for years. Steve Jobs did the same. Why? Are they just minimalist guys who love clipping coupons? No, obviously not. They do this because they know that taking a high salary is the most tax-inefficient way to access money. If Bezos took a $500 million salary, he'd pay nearly half of it to the IRS. That's just bad business. So if they don't have high incomes, how do they buy the yachts? How do they buy the $100 million compounds in Hawaii? How do they fund the trips to space? This brings us to step 1 of our 3-part framework: buy. The wealthy don't focus on getting paid. They focus on owning things. They buy assets. Now, when I say assets, I don't mean your car, which drops in value the second you drive it off the lot. I don't even really mean your primary house, although that's better than renting. I'm talking about income-generating or appreciating assets. Businesses, commercial real estate, apartment complexes, and most commonly, massive amounts of equity stocks in their own companies or other companies. The goal here is to acquire things that go up in value over time. Let's go back to our Bezos example. His wealth isn't his $81,000 salary. His wealth is the millions of shares of Amazon stock he owns. Here is the magic trick of the tax code. Growth is not income. Let's say you buy a share of a stock for $100. A year later, that stock is worth $200. You have made $100 on paper. You are $100 richer, but the IRS doesn't care. They don't see that $100. It is an unrealized gain. It's imaginary money as far as the taxman is concerned. You could own an asset that grows from 1 million to 1 billion over 20 years. And as long as you just hold on to it, as long as you don't sell it, you will pay exactly $0 in tax on that massive wealth creation. This is where the disconnect happens for most of us. We measure our financial success by our paycheck. They measure their success by their net worth growth. Imagine you're growing a tree in your backyard. You plant a sapling. It grows into a massive oak tree. It's worth a fortune now because of the lumber. The IRS is basically standing outside your fence, looking at the tree, saying, "Wow, nice tree. Let us know if you ever chop it down." They only tax the timber when you cut the tree down and sell it. That's called realizing a gain, and that triggers capital gains tax. Now, capital gains tax is already lower than regular income tax, usually around 20% for high earners. So even if they do sell, they pay less tax than a high-income dentist. But the true masters of the universe think, why pay 20% if I can pay 0%? They don't want to chop down the tree. They love that tree. That tree is their power, their influence, their legacy. Selling stock means giving up control of their company. They don't want to do that. So they have billions of dollars locked up in these assets. But they have very little cash in the bank because they aren't taking big salaries. This creates a problem. You can't buy groceries with an Amazon stock certificate. You can't pay for a private jet with a deed to a commercial building. You need cash. You need liquidity. For you and me, if we need cash, we have to sell something or earn more. But if you have massive assets, you have a third option, the most powerful option. Step 2, borrow. This is the engine of the whole strategy. This is the part that really blows people's minds when they first grasp it. If you have $1 billion in stock, and you want $10 million to buy a new beach house, you do not sell $10 million worth of stock. If you did, you'd have to sell maybe $13 million worth just to cover the taxes on the sale. Instead, you walk into a bank, a very specialized private bank that caters to ultra-high net worth individuals. You say, "Look, Mr. Banker, I have $1 billion in stock here. It's very stable, it's growing every year. I need some walking around money. How about you loan me $10 million, and we'll use my stock portfolio as collateral?" The banker's eyes light up. This is the easiest loan in the world for them to write. It's virtually risk-free. If you don't pay them back, they just take a tiny sliver of your stock. Because it's so low risk, they offer you an incredibly low interest rate. Sometimes practically nothing, 1%, 2%, maybe 3% in higher rate environments. Much lower than a mortgage and infinitely lower than a credit card. So, you take the $10 million loan. You buy the beach house. Now, here is the critical part, the punchline of this whole section. Debt is not taxable income. When the bank wires $10 million into your account, the IRS doesn't see that as income. It's a liability. You have to pay it back. So, zero taxes on that $10 million cash infusion. You now have the beach house, you still own all your stock, and the stock is hopefully still growing faster than the tiny interest rate on the loan. You are using your assets as leverage to live a tax-free lifestyle. This is often done through something called a securities-backed line of credit, or S-block. It's basically like a home equity line of credit, which many homeowners have. But instead of using your house as collateral, you use your investment portfolio. And the crazy thing is, they just keep doing this. Need living expenses for the year? Borrow it. Need to buy a new company? Borrow against your current company to fund the acquisition. You might be thinking, wait, Marcus, this sounds dangerous. Isn't debt bad? What if the market crashes? That's a very normal person way of thinking. We are taught to fear debt. Debt is shackles. Debt is stress. But for the wealthy, debt is just a tool. It's a lever. Yes, there are risks. If the stock market drops by 50%, the bank might make a margin call, meaning you have to put up more collateral or pay back some of the loan immediately. That can get ugly. It happens to billionaires sometimes during major crashes. But generally, these folks are borrowing a very small percentage of their total value. If you have $1 billion, borrowing $50 million is pretty safe. Even if the market tanks, you're probably fine. So they live on borrowed money. They pay tiny interest rates, which, by the way, can sometimes be tax deductible if used for investment purposes. They pay no income tax because they have no salary, and they pay no capital gains tax because they never sell. It's a perfect, closed loop of tax avoidance. But wait, there's a catch, right? You have to pay back loans eventually. If you borrow $50 million over 10 years to fund your lifestyle, eventually the bank wants that money back. How do you pay it back without selling stock and triggering taxes? Well, sometimes they do sell a little bit of stock here and there to service the debt. But ideally, they just keep rolling the debt over until the inevitable happens. Until they reach the final step of the strategy. Step 3. Die. Yeah, I told you it was morbid. But in the world of high finance and tax planning, death is not just an emotional event. It is the ultimate tax strategy. It is the get-out-of-jail-free card for a lifetime of accumulated gains. This all hinges on a loophole in the US tax code known as the step-up in basis. This is probably the single most powerful wealth transfer mechanism in existence, and very few normal people understand it. Here's how it works, as simply as I can put it. Let's go back to that tree example. Let's say you bought that sapling for $10. That's your cost basis. The original cost. Over 50 years, it grows into a massive, rare timber tree worth $10 million. You have $9,999,990 of unrealized gains sitting in that tree. If you sell it the day before you die, you owe taxes on almost all of that $10 million. But if you die owning the tree and you leave it to your child in your will, something magical happens. When your child inherits the tree, the tax code resets the basis of the tree to its value on the day you died. So your kid inherits a $10 million tree. Their cost basis is not the $10 you paid. Their cost basis is $10 million. If they turn around and sell that tree the very next day for $10 million, how much gain do they have? Zero. How much tax do they pay? Zero. That entire lifetime of growth, all that value you created while you were alive, all that wealth you borrowed against to live your tax-free lifestyle, it is wiped clean by the IRS upon your death. The capital gains tax liability just vanishes into thin air. It's staggering when you really think about the scale of this. We are talking about trillions of dollars over time that just resets. So, what happens to that debt you accumulated while you were alive? That $50 million you borrowed to buy beach houses and fund your lifestyle? Well, your estate still owes that money. Your heirs have to pay back the bank. But now it's easy. They inherit your billions in stock with the stepped-up basis. They sell $50 million worth of stock to pay off the bank loan. And because of the step-up, they pay no tax on that sale. They pay off your lifestyle debt tax-free, and they keep the remaining billions to start the cycle all over again. Buy assets, borrow against them, die and reset the basis. It is a perpetual motion machine of wealth preservation that completely bypasses the income tax system that you and I are stuck in every April. And honestly, it's frustrating. It feels like a cheat code that only unlocks after you reach a certain net worth. And that's because it basically is. You can't go to a normal bank with a $10,000 savings account and ask for a 2% loan against it to buy groceries. They'll laugh at you. This is a game for the whales. But I think it's important to talk about this not just to get angry, but to understand the mechanics of the game we are all playing. When you lay it all out like that, buy, borrow, die, it can feel pretty disheartening. It feels like two completely different sets of rules. And honestly, it kind of is. There are the rules for people who earn income, and there are the rules for people who own assets. If you are working for a W-2 paycheck, you are swimming upstream against the tax code. The system is designed to take a chunk of your money before you even touch it. The wealthy have figured out that the key is to stop swimming. Get out of the river entirely. Build a boat. Now, I know what you're thinking. Marcus, this is great info, but I don't have $1 billion. I don't have an Amazon to borrow against. How does this help me? Look, you and I are probably never going to be able to execute buy, borrow, die at the level of a Jeff Bezos or an Elon Musk. We aren't going to get those 1% interest loans on $100 million lines of credit, but understanding the philosophy is life-changing. The takeaway isn't just to be angry at the rich. The takeaway is to learn from the playbook. It teaches us that if your entire financial plan is work harder to get a higher salary, you are playing a losing game against taxes and inflation. You have to shift your mindset from thinking about income to thinking about assets, even on a small scale. This is why maxing out your 401k or IRA is so important. It's one of the few ways normal people can shield income from taxes and buy assets. This is why owning a home, despite all the headaches, is generally better than renting long-term. You are building an asset that you can, eventually, borrow against via a HELOC or pass down to your kids with a step-up in basis. It's why building a side business that has actual equity value is way more powerful than just getting a second job Uber driving. The goal is to move as much of your financial life as possible out of the income column and into the asset growth column. It's hard. It takes time. You can't just snap your fingers and switch into billionaire mode. But the first step is seeing the matrix. It's realizing that sinking feeling you get during tax season isn't just in your head. You are feeling the weight of a system that is designed to tax labor heavily while letting capital grow gently. Buy, borrow, die. It's cynical. It's brilliant. And it is the reality of how big money works. The sooner we understand the rules of their game, the sooner we can start trying to play a better version of our own. Thanks for watching. If this made your brain hurt a little bit, or made you look at your W-2 a little differently, hit that like button and subscribe. I'm going to keep diving into this stuff because, honestly, I can't stop thinking about it. See you next time.